The tariff chaos just escalated. President Trump's new plan gives a 90-day delay to most countries, but not to China. Markets soared, then sank as uncertainty took over. We'll break down the real implications of this move, what it means for the dollar, treasuries, and why the CCP's response tells you more than you think. At the end, you'll understand how this one policy is reshaping global markets.
Gary, moving into thing number two, thing number one on the written version, but just a little adjustment. Again, having Dean on the show. Gary, we're going to talk about tariffs. Dean even mentioned it a couple times in the last thing. It seems like there's been some pause, some start. Talk about delays. Looks like 90-day delay for everyone but China, which, Gary, you're calling thing number two, tariffs for one. Tell us more what we need to know about that.
So, Rob, it's incredible. I was writing this version of the 5 things last Friday, and it had only been a week and a couple of days since President Trump had announced his tariff plan. It feels like it's been, 5 or 6 full market cycles since then. Last Sunday, 8 days ago, I wrote a blog post for DKI premium subscribers explaining to them how I was thinking about portfolio exposure because tariffs are a big deal right now. And at the time, I explained that there were 3 likely scenarios in the near future. One was a market-crushing implementation of the higher tariff levels that had been disclosed before. The second one was negotiating lower tariffs with the 50, now more than 70 countries that are offering lower tariffs on U.S. goods. And the third option was a 90-day delay of tariffs so that those negotiations could take place. And I wrote that the last one would send markets soaring. Well, we got a combination of options 2 and 3, a 90-day pause to negotiate with, I think it's now 75 countries, including the EU, and, big Chinese alternate, Vietnam, India wants to talk. So there are a lot of, really important economic partners that want to have these discussions. Anyway, when all of this happened, equity indexes went from down big to up huge. And then much of those gains were wiped out the next day as markets realized, wait, this doesn't resolve the escalation between the US and China. And everybody realized, oh, wait, we haven't solved this. We just have another 3 months of uncertainty, and the market doesn't like uncertainty. So a lot of those gains came back. And for people who want to understand the tariff situation better, I would urge you check out on our YouTube channel. There is a discussion we did last week with Alex McCrease, who explained how the Trump administration is viewing and calculating tariff levels. Now, the people who watch that, you may agree, you may not agree, but everybody's saying they don't know what they're doing. They have no plan. They're calculating this wrong. That is not correct. There is a plan, and these tariffs were calculated according to a formula. There weren't mistakes. Now, you might not like the plan, and if that's the case, we should have that conversation. But I think Alex does a great job of explaining what the administration is thinking and where the ideas came from. So that's, I think that's worth watching.
Gary, so obviously, you talked about the markets fell, then they rose again, a little bit of down day, big day today, another good day today. With all of that fluctuation, I mean, what are the other implications that you're looking at with this tariff delay other than what we've seen kind of the market rising over the last couple of days?
So, Rob, in the prior segment, Dean Smith of Folio Beyond was talking about what was happening with interest rates and sort of, normalized rates on treasuries. And so not last week, and the weekend before, we saw the yield on the 10-year treasury dip below the 4% level, which was, I think 80, 90 basis points below where they were just 2 months ago. That is a huge move down. And then they rocketed right back up. I think they hit 4.7, 4.8, something like that. As of right now, 4.4%. So above where they were at that point. Now, there's been some speculation on that because obviously the yield we're getting on our treasuries, or paying on our treasuries, is really important to any financial calculation. And so what a lot of people were saying is part of the move might have been related to foreign government selling. There have been a lot of rumors. China owns, several $1 trillion of U.S. treasuries. And so they might have been selling. And there also was a lot of discussion related to stress on the basis trade. Now, for people who aren't following this on a regular basis, the basis trade is simply taking advantage of a small difference between the current rates on Treasury securities and on futures. And so they'll own one, they'll short the other, and those spreads, those differences in yields are very, very small. And so they use leverage. And these trades get leveraged up sometimes 50 or 60 times. So, if someone has $1 million of capital on this trade, they might have positions adding up to 50 or 60 million dollars. Now, what do you do when their starting capital on that is $100 million? All of a sudden, at a few billion dollars here, a few billion dollars there, it becomes a huge problem. And so there were these widespread fears and speculation that fears of a subsequent bank failure due to excess leverage on an unwinding trade led to the 90-day tariff delay. Okay, so the sort of the chain of events there, rather, is you have this basis trade. It starts to lose money at 50 or 60 times leverage. People realize, oh no, that's a lot of money I could lose. And so they start to unwind it. And as they unwind those trades, the banks that have lent them those 50 to 60 times their money could fail because of excess leverage on this trade, right? If there are losses, if the fund goes out of business, the banks may be holding it. And my response, this was something I wrote on X at the time, was whether you agree with the Trump tariff strategy or not, can we all just agree that having too big to fail institutions that alter national policies is a bad idea, right? I mean, people are really speculating that we changed our national economic policies to make sure that banks didn't fail. This is insane. The right answer here is we either let them fail or we force the banks to reduce systemic risk. China, by the way, what they did was they increased their tariff rates and their threats, right? So they raised tariffs on U.S. goods being sent there. And then they made a whole bunch of threats and they raised their own tariffs. They lobbed some childish public insults. And the one that to me was really telling was they threatened to stop respecting the IP of U.S. companies operating in China. They flat out said, hey, if you're a U.S. company operating in China, we might steal your property and start companies to compete with you on that. This is something that China has been doing for years. It's something they claim they haven't been doing. And I think that move tells you a lot about the business ethics of the CCP, that stands for Chinese Communist Party. And to use their language, we urge them to abandon their wrong thought and apologize for their wrong action.
Interesting stuff here, Gary, and we'll be sure to keep you in tune with everything that's happening with the tariffs, especially over the next 30, 60, 90 days, as we get more insight and clarity into what's actually happening. You're watching this week's version of the 5 Things from Deep Knowledge Investing. This is the Tariffs for One issue. Be sure to subscribe to our YouTube channel. Give us a like, comment, or thumbs down if you disagree. Let us know why. Head over to deepknowledgeinvesting.com. Sign up for a free subscription. That'll get you added to our mailing list, get you notifications on new content being added to the DKI website.